The moment you think you understand what is happening in the silver market is usually the moment you're already late, because the most dangerous shifts never announce themselves loudly. They unfold quietly beneath the surface, while most people are still arguing about prices on a chart. And right now, silver is flashing warnings that almost no one is prepared for. Not because silver is about to disappear tomorrow, and not because the world is ending, but because the structure holding this market together is under more pressure than it has been in decades. If you hold silver, trade silver, or are even thinking about silver as a safe asset, what is happening right now matters far more than most headlines suggest. For years, silver has lived in the shadow of gold. Gold gets the respect, the headlines, the central bank attention. Silver is treated like the cheaper cousin, the industrial metal that sometimes behaves like money. But that dual identity is exactly what makes silver uniquely fragile in moments of stress. It is pulled in two opposite directions at the same time. On one side, it is essential for modern life. Electronics, solar panels, medical devices, data centers, electric vehicles. Silver is not optional for these industries. On the other side, it is still a financial asset, traded, shorted, leased, and papered over in ways that assume smooth functioning and endless supply. When those two worlds collide, silver does not move gently, it snaps. The trouble begins with supply, not in the dramatic way people expect, but in a slow tightening that compounds over time. Most people assume silver comes from silver mines. In reality, the majority of silver production is a byproduct of mining for other metals like copper, lead, and zinc. That means silver supply is not primarily driven by silver demand. It is driven by decisions made in entirely different markets. When base metal mining slows, silver production slows, regardless of how badly the world needs silver. And that is exactly what has been happening. New large-scale mining projects take years, sometimes decades, to come online. Ore grades are declining, costs are rising, environmental regulations are tightening. All of this makes it harder to increase supply quickly, even if prices rise. At the same time, demand is quietly becoming less flexible. Industrial demand for silver is not speculative. A solar panel manufacturer cannot simply decide to stop using silver because prices rise. A medical device company cannot swap it out without redesigning entire systems. These industries plan years ahead, locking in assumptions about availability that depend on stable supply chains. When silver becomes harder to source, the pressure does not show up as a polite price increase. It shows up as procurement stress, delays, and sudden competition for physical metal. Layered on top of this is the paper silver market, which is where the real fragility hides. Futures contracts, options, unallocated accounts, and synthetic exposure have created a system where far more silver is promised on paper than exists in physical form. Under normal conditions, this works because most participants never ask for delivery. Contracts are rolled, positions are closed, cash settles the difference. But this system depends on confidence. The moment enough participants decide they want actual metal instead of paper promises, the math breaks down very quickly. This is where silver holders need to pay close attention. Trouble does not mean prices collapse. Trouble means the rules of the game start changing. Exchanges raise margin requirements, delivery timelines stretch, premiums between paper prices and physical metal widen. Suddenly, the price you see on a screen has less and less to do with the price required to actually obtain silver in the real world. That gap is not theoretical. It has appeared before, and when it does, it signals stress, not stability. Another overlooked pressure point is inventories. Reported stockpiles are often treated as if they are all equally available. They are not. Some silver is already committed to industrial users, some is tied up in long-term contracts. Some exist only as claims layered on top of the same bars. When demand spikes or supply stumbles, the amount of silver that can actually move becomes much smaller than reported numbers suggest. This is how shortages begin without anyone officially declaring one. For holders, the danger is not simply volatility, it is misunderstanding the nature of what they own. Paper exposure behaves very differently from physical metal during stress. Exchange-traded products promise liquidity, but that liquidity depends on authorized participants, market makers, and settlement systems all functioning smoothly. In moments of disruption, those assumptions can be tested. Redemption mechanisms can change, terms can be adjusted, cash settlement can replace metal delivery. None of this is illegal. It is built into the structure. But it can surprise investors who believed they had direct exposure to silver itself. Physical holders face a different challenge. Storage, liquidity, and security matter far more during stress than during calm markets. Premiums can spike, but selling quickly at a fair price may not be as easy as expected. Dealers adjust spreads, buyers become selective. The idea that physical silver is instantly liquid at all times is comforting, but not always accurate. Serious trouble does not mean you cannot sell. It means the process becomes less predictable. The broader financial environment only amplifies these risks. Rising interest rates, tightening credit conditions, and geopolitical uncertainty all interact with silver in complex ways. Higher rates increase the cost of holding inventory for industrial users. Supply chain disruptions make just-in-time procurement risky. Currency volatility changes the incentives for producers and consumers across borders. Each factor alone is manageable. Together, they create a system with very little slack. What makes this moment especially important is timing. Transitions do not happen all at once. They happen gradually, then suddenly. For long periods, silver can look boring, range-bound, ignored. That is often when structural pressure is building. By the time the mainstream narrative shifts, the easy adjustments are already gone. Holders are forced to react instead of prepare. Preparation does not mean panic, it means clarity. Understanding what kind of exposure you actually have. Understanding how that exposure behaves under stress. Understanding the difference between price movement and market function. A rising price can still hide dysfunction. A stable price can mask growing scarcity. The screen does not tell the whole story. Silver has always been a metal of contradictions. It is abundant enough to be used everywhere, yet scarce enough to matter. It is both money and material. That balance is delicate. When it is disturbed, silver does not whisper. It moves decisively. The trouble signals now are not guarantees of collapse, but they are warnings that assumptions built during calm periods may not hold. For holders, the most important question is not where silver's price will be next month. It is whether the system supporting that price can absorb the pressures forming beneath it. Markets fail slowly, then all at once. Those who understand that difference are rarely surprised. Those who do not often realize too late that the real risk was never the price, but the structure behind it. The recent signals from industrial procurement, declining mine output, and the growing gap between paper and physical silver highlight the systemic pressures building quietly. These are not flashy headlines, but subtle indicators that often precede major market adjustments. Companies scrambling to secure physical silver for electronics, solar panels, and EV batteries are quietly bidding up premiums. Futures markets show tight spreads narrowing, and delivery requests on certain exchanges have surged unexpectedly. For those watching only headline prices, this tension is invisible, yet it is shaping the real market in ways that could soon be impossible to ignore. The irony is that silver's dual identity, as both an industrial necessity and a financial asset, amplifies every ripple. Investors seeking to profit from volatility can unintentionally tighten physical supply. Manufacturers hedging against price swings may hoard metal, further straining available inventories. Each participant reacts rationally within their own frame of reference, yet collectively these decisions can destabilize the market. This is a lesson that is repeated throughout financial history. Individual rationality does not guarantee systemic stability. Another factor adding pressure is global supply concentration. A handful of countries dominate silver mining and refining. Any disruption, whether political, logistical, or environmental, can immediately tighten global availability. Mining strikes, regulatory changes, or even geopolitical tensions could suddenly make silver harder to obtain, regardless of demand forecasts. And unlike gold, which has a robust reserve system in private and central bank holdings, silver reserves are limited and often already committed to industrial uses. The slack that might buffer other metals simply doesn't exist in meaningful quantities for silver. For investors, understanding market mechanics is now as important as understanding price trends. Paper silver is subject to the complexities of counterparty risk, settlement procedures, and liquidity constraints. Physical silver, while immune to paper market intricacies, faces challenges of storage, transport, and market access during high demand periods. Each form of ownership carries benefits and risks that are amplified under stress. The broader macroeconomic environment compounds these dynamics. Rising global inflation, currency volatility, and shifts in interest rates all influence how silver is held, sold, or purchased. Central banks continue to tweak policy, and global economic uncertainty makes hedging strategies more complex. As the world economy transitions, industries that rely on silver face both supply and cost pressures. This is not speculative. These are operational realities that can directly impact production and investment behavior. One of the most instructive lessons from past markets is the speed at which perception can change. Silver can trade steadily for months, even years, creating a sense of calm. Then suddenly, the combination of industrial demand surges, paper market constraints, and geopolitical shocks can cause rapid price movements and liquidity stress. The quiet build phase is often overlooked because it lacks dramatic news coverage, but this is precisely when systemic vulnerabilities form. Awareness, preparation, and proactive risk management are critical in these periods. So, what should holders and investors consider today? First, clarity about the type of exposure you hold: physical, paper, or industrial. Second, an understanding of how your exposure behaves under stress: market, operational, or geopolitical. Third, recognizing that price alone does not tell the full story. Premiums, delivery delays, and inventory constraints often signal real pressure before headline prices react. Finally, the broader economic and geopolitical context matters. Markets are interconnected, and silver, despite its size, is sensitive to global forces. The future of silver is not predetermined, but ignoring these pressures is risky. Unlike more abundant commodities, silver's industrial and financial roles make it uniquely sensitive to sudden changes in supply and demand. The market is not collapsing yet, but signals suggest it is moving toward a phase where conventional assumptions about liquidity, availability, and price stability may no longer hold. In short, silver is at a crossroads. Its dual role, constrained supply, growing industrial demand, and systemic vulnerabilities, create a scenario where the market's response to stress could be swift and unpredictable. Those who understand these dynamics and prepare accordingly stand a better chance of navigating volatility successfully. Those who rely on past norms or superficial indicators risk being caught off guard. The message is simple but critical. Watch beyond the charts. Monitor supply chains, industrial demand, and delivery premiums. Distinguish between paper and physical exposure. Understand that silver's behavior is a reflection of deeper structural realities. And recognize that in a market as nuanced and pressured as silver, preparation and understanding are the true keys to navigating uncertainty. As the pressures intensify, the implications extend far beyond individual investors. Industries dependent on silver, electronics, solar energy, medical devices, and electric vehicles face increasing costs and potential production bottlenecks. When manufacturers compete for limited physical metal, premiums rise and supply chains tighten. This, in turn, can ripple into broader markets, influencing commodities like copper, lithium, and even gold, as investors and industrial players adjust strategies in anticipation of constrained resources. Global trade dynamics also play a crucial role. Countries with large silver reserves like Mexico, Peru, and China have growing influence over both industrial allocation and financial speculation. Any policy shift, export restriction, or geopolitical tension in these regions could exacerbate supply pressures. Moreover, currency fluctuations affect the global purchasing power of buyers and the relative attractiveness of holding silver versus other assets. The interconnectedness of finance and industry means localized disruptions can trigger worldwide effects. Financial instruments tied to silver, ETFs, futures, options add complexity. While they provide access and liquidity for investors, they also introduce systemic risk. In times of stress, redemption pressures or settlement delays constrain these instruments, creating feedback loops that amplify market volatility. The recent history of commodity squeezes and short covering episodes illustrates how quickly sentiment can shift, sending prices sharply higher in a compressed time frame. For individual holders, the lesson is clear. Diversification and situational awareness matter. Physical silver offers security against counterparty risk, but requires careful planning for storage and liquidity. Paper silver provides accessibility, but is subject to market mechanics that can behave unpredictably under stress. Understanding the distinctions, as well as monitoring indicators like delivery volumes, premiums, and industrial consumption, is essential for navigating the evolving landscape. 3 key takeaways emerge. 1. Supply is finite and increasingly constrained. Industrial demand is rising faster than new production, while global reserves are limited. Understanding the physical market is crucial. 2. Market signals are subtle but actionable. Look beyond headline prices to track premiums, delivery times, and inventory levels. These often provide early warnings before dramatic price movements occur. 3. Global and systemic factors amplify risk. Currency fluctuations, geopolitical events, and policy decisions can accelerate shifts in both industrial and financial markets, affecting all silver holders. The warning is unambiguous. Silver is no longer a static or predictable asset. The convergence of industrial necessity, financial speculation, and geopolitical influence creates conditions where traditional assumptions about liquidity and price stability may fail. Those unprepared for these pressures risk encountering scarcity, sudden price spikes, or operational disruptions. Ultimately, the evolving silver market is a reminder that the forces shaping commodities are complex and interconnected. Awareness, informed strategy, and proactive risk management are essential. Keep monitoring supply chains, industrial demand, and financial markets, and recognize that the silent pressures building today could erupt tomorrow. This is a call to understand the depth of the market, act judiciously, and never underestimate how swiftly circumstances can change. The hunt for understanding and preparedness has already begun. Those who watch, analyze, and position themselves wisely will navigate the emerging silver landscape with resilience and insight, while those who ignore the signals may find themselves unprepared for the market shocks that are quietly forming today.